Hello and welcome to BYJU'S Exam Prep IAS. Welcome to another session of Indian Economy Essentials. And in today's session, let's have a discussion regarding what are these additional Tier 1 bonds or AT1 bonds. Now before starting the discussion, what is the need for you to understand AT1 bonds? Please have a look at the snippet of the newspaper or the newspaper cutting here. Yesterday in the Hindu newspaper, there was an article regarding Credit Suisse, wherein the regulator in this country has wiped off or has written off $17 billion worth of additional Tier 1 bonds. And is it the first time that the concept of AT1 bonds is there in the newspaper? Of course, no. Couple of months ago, there was also a newspaper article regarding the Yes Bank in India. Right, that is Yes Bank of India writing off more than 8,000 crore worth of additional Tier 1 bonds. Now looking at all of this, for civil service examination, there is going to be a probability of question being asked on the concept of these bonds. So in this session, let's try and understand what are these bonds, why they are generally in the newspaper, why banks issue these bonds, and why these are written off. Let's understand this. Point number one. In case of the banking sector, we are in the process of implementing Basel guidelines. We have already implemented Basel guidelines or some of these are Basel guidelines. For example, we have implemented Basel 1, Basel 2, and we are in the process of implementing Basel 3. Under Basel 3, there is a very important provision called as Capital Adequacy Ratio. CAR, Capital Adequacy Ratio. Now, what is the idea of a capital adequacy ratio? As a bank, it is involved in multiple activities, and when they are involved in multiple activities, the bank will also face multiple types of risks. For example, under Basel guidelines, we divide the risks into three types: operational risk, credit risk, market risk. And when you face these types of risk, there is a possibility that the bank might incur a loss. And because it is a bank, if it incurs a loss, we should have certain shock absorbers. In simple terms, we should have certain amount of capital to absorb these losses. And that is where the concept of capital adequacy ratio will actually kick in. As per the Basel guidelines, in India, the capital adequacy ratio that we are supposed to maintain is 9% of risk-weighted assets, RWA. Now, whenever you talk about capital here, in a bank, capital can be held in two forms. Right? That is a Tier 1 capital and Tier 2 capital. Tier 1 and Tier 2. Tier 1 capital, best example is equity, the shares which are issued by the bank, and additional Tier 1 capital. We'll connect it to the article, have patience. Additional Tier 1 capital. And Tier 2 capital is basically, example of this is Tier 2 bonds which have been issued by multiple banks in India. For example, PNB. For example, Dena Bank. They have issued Tier 2 bonds. Tier 2 bonds is an example of Tier 2 capital. Now understand the technicality here. Both the Tier 1 and Tier 2, right, these are part of the capital. And what is the use of the capital held by the bank? The capital will be used as a shock absorber. That is, in case there is a loss incurred by the bank, that shock will be absorbed by this capital. But between these two capitals, Tier 1 and Tier 2, Tier 1 is more reliable. Tier 1 is more reliable. Tier 1 can absorb the losses much more easily and much sooner compared to Tier 2 capital. And that's the reason whenever you read about Basel guidelines, you will realize that, or you will just make an observation here, the banks should have more Tier 1 capital compared to Tier 2 capital. Now within Tier 1, further there is a division like this. Within Tier 1, there is a further division. That is, a Tier 1 is divided into Common Equity Tier 1, CET1, and Additional Tier 1. For common equity Tier 1, the banks issue equity, that is shares in the market, raise the capital. And for additional Tier 1, the banks will issue additional tier 1 bond and raise the capital. And any amount that is collected by the bank, either by issuing the tier 2 bonds, additional tier 1 bonds, or under the common equity tier, all of them will be counted as a part of capital adequacy of a bank. Now, higher the capital adequacy, that is, a bank has more capital, it simply means the bank has more loss absorption capacity. The loss absorption capacity or the shock absorption capacity of the bank will be very, very high. That is a precise reason generally you will see that whenever the capital adequacy ratio of banks will start declining, there is a concern raised by the central bankers. There is a concern raised by the investors because it simply means the loss absorption capacity of the bank is actually declining. Now within this, come to the concept of additional tier 1 bonds. What is the speciality about additional tier 1 bonds? One, these are perpetual bonds. Remember this, these are perpetual bonds. What do you mean by perpetual bonds? These do not have any maturity period. These do not carry any kind of a maturity period. Sir, what is the meaning of the term maturity period here? For example, imagine you purchase a corporate bond, tenure 5 years. Government bond, tenure 2 years. What is the meaning of it? The tenure of the bonds, the maturity period of the bonds is 2 years or 5 years, whatever the time period is there. But in the context of additional tier 1 bonds, they do not carry any maturity period. These are perpetual. Perpetual in the sense, these are issued no doubt by the banks, but the bank will decide for what duration these will be there in the market. That is, they will not have any maturity period. Rather, there is an option for the bank which is called as recalling option. Recalling option means the bank will decide when they want to purchase the bond back from the investors. Very simple. The bank will decide. Unlike, let's say, a government bond of maturity 2 years, wherein after 2 years, no doubt maturity period is over. But in case of these bonds, these are perpetual in nature. There is no maturity period. The bank might recall after 5 years, after 10 years, etc. like this. That's the first very important feature. Second very important feature. In case there is an event in the bank which will lead to, let's say, loss of profitability, or the bank will move towards point of non-viability. What is the meaning of it? The losses of the banks are increasing. The bank is not able to provide or satisfy the coupon rate, and right in that situation, the central banker of that country might allow the bank to simply write off or convert these bonds. Understand this carefully. Right, imagine a bank is there, they've issued lot of these, right, let's say additional tier 1 bond or tier 2 bonds. But if they honor the payment, if they make the payment, then basically the bank is going to incur the losses to such an extent that it will be very, very high. In such situations, the central banker will allow these banks to either convert them into equity, or simply write off. Sir, what is the meaning of the write-off here? Write-off simply means the bank might decide not to pay any interest to you and also will not pay any principal back to you. Imagine you have purchased one of these additional tier 1 bonds. Value is 100 rupees. That's your principal amount. You will get the coupon amount, interest rate. In addition to that, once the bank will repurchase the bond back from you, they will have to pay the 100 rupee back to you. In case the bank is incurring the losses to a very great extent, the financial position of the bank is becoming weaker, they will decide not to give you any interest. They will also decide not to return your principal, that is writing off. And another option that is available to them is these can be converted. These can be converted into equities. That's the reason one more name for these kind of bonds are COCO bonds. Remember this. In short, they will write it as COCOs. Contingent convertibilities or contingent convertibles. What do you mean by contingent convertibles? Contingent in simple terms refers to a situation or a condition. So if you reach that particular condition, only then these will be converted. Hence, contingent convertibles. For example, AT1 bonds are contingent convertibles. The bank has an option of converting them into equity or simply writing them or cancelling them off. Now, looking at all of this, many of you will see that. Right now, before going forward, let me add one more point here. These are unsecured. These are unsecured in nature. These are unsecured in nature. Unsecured means what? Whenever you borrow something and you provide a security or a collateral, these are called as secured. And whenever you borrow something and you do not provide any security, these are called as unsecured. So whether you talk about tier 2 or AT1, both are unsecured in nature. So looking at all these features, now you will realize that, okay, these are unsecured. There is no guarantee that the bank will pay the interest as well as the principal amount. There is no maturity period also. So the risk is very high. One thing is very sure, risk involved in investment of these bonds is very high. Now you will ask me, sir, if the risk is very high, why will anybody invest in this? Why will anybody actually invest in this? Right? The reason is that the coupon rate or the interest rate on this is also higher. Generally, the bonds which are issued in the form of AT1 bonds carry somewhere in the range of around 60 to 80 basis points interest rate higher than the interest rate on government bonds. For example, Punjab National Bank, PNB, Punjab National Bank is expected to issue the bonds in this week. And the coupon rate to be offered on this is 8.5%. SBI couple of months ago issued such bonds. Coupon rate offered is 8.25%. Same SBI last year had issued one more round of AT1 bonds. Coupon rate was more than 7.5%. So whenever these banks are going to issue these bonds, either let's say AT1 bonds or tier 2 bonds, the risk associated with these is generally higher. And when the risk is higher, the coupon rate or the interest rate offered to the investors should also be higher. And because these are so risky, right? Remember this, because these are so risky, SEBI, after the Yes Bank debacle, had implemented or has implemented a check and a balance in the system. A restriction has been imposed by SEBI. That is, SEBI says, do not market these to individual investors. Do not market it. These are very risky. And second, whenever these bonds are issued in the market, issue them in the lot of 1 crore rupees so that retail investors will not be interested in such bonds. So these are some of the very important features. But before going forward, what is the difference between tier 2 bonds and additional tier 1 bonds? Right, understand this. Tier 2 bonds are unsecured. There also, if the bank reaches a position that is a point of non-viability, that is, the bank cannot continue to operate, the bank can simply write off these tier 2 bonds. These are also COCOs. But the important difference between tier 2 bonds and additional tier 1 bonds is, tier 2 bonds have maturity period. They have maturity period. Generally, these are issued. For example, Dena Bank issued tier 2 bonds with a maturity period of 10 years. So there's a tenure that is decided before issuing these bonds. The tenure is well known to the investor. That's a very important distinction between AT1 and tier 2. Beyond this, already I've mentioned, AT1 bonds have a better risk absorption capability compared to tier 2. These will absorb the losses much more earlier compared to tier 2. That is, as per the guidelines issued under Basel, if the common equity tier reaches to 6.125%, automatically additional tier 1 bonds are written off or converted. And what is the importance of all of this? Please understand the background to these bonds. These kinds of bonds were introduced under Basel-III, and Basel-III was introduced after 2008 global financial crisis. During 2008 global financial crisis, what happened? Many of the banks became dependent on the assistance of the government. That is, the taxpayers' money was used to provide bailout packages to these banks which were there in the crisis. So obviously there is always a criticism. If the banks are incurring losses, why should the taxpayer bear the burden of it? Why should the taxpayer money be used for all of it? And that's the reason why the concept of the tier 1 bonds or additional tier 1 bonds, tier 2 bonds, common equity tier, etc. was introduced, so that the burden now can be shifted from the taxpayers to the investors, to the shareholders of the bank, etc. And that is the background of introduction of these kinds of bonds. Now come to the point here. What has been done here? The regulator, that is the central bank or the regulator of this country, has announced that the additional tier 1 bonds which are issued by the Credit Suisse will be written off, will be reduced to 0 rupees or $0. So in a single decision that was done by this authority, the value worth $17 billion worth of bonds has been reduced to $0, which is a huge impact on the investors. How is that possible? How is that possible? Because please understand, some of you will be confused here. Confusion is that you would have read in the papers, or let's say in the books or in your graduation, that whenever you talk about the capital structure, the bond holders are given a preference over equity holders. The bond holders are given a preference over equity holders. That is, imagine a bank is shut down or a company is shut down. Whenever the money has to be given back, the bond holders are given the first preference compared to equity holders. But in this case, one more bank, UBS, has proposed to buy out Credit Suisse. It has proposed to buy out Credit Suisse. As a part of this deal, certain amount of money will be given to equity holders, but nothing will be given to the additional tier 1 bond holders. How is that possible? Is it not going against the traditional concept? Answer is yes. Answer is yes. That is, whenever such bonds are issued, the regulators clearly specify, I repeat, the regulators clearly specify, in case of a requirement, in case of bank reaching certain position, fiscal position, weaker financial position, bondholders' value might be reduced, might be nullified to 0 rupees or can be converted. Apply the same logic in the context of Credit Suisse, yes bank, you will realize it. So whenever you talk about additional tier 1 bonds, generally the bondholders are superior compared to equity holders in a capital structure. Right? But in the case of additional tier 1 bonds, no, they do not carry a superiority. They will be affected first, right? Which is against the traditional concept of a capital structure. Now, apart from this, what is the impact of it? What will be the likely impact of all of this? First, investor confidence in the banking structure will be affected. No doubt regarding this. Investors' confidence in the banking structure will be affected. In the last couple of days, if you have seen the newspapers, you will realize that the market prices of the shares of many of these bonds, that is, the market prices of shares of banks, as well as market prices of many of these bonds issued by the banks has taken a hit. Especially in the European market, the market prices of both the shares of the banks as well as bonds have actually come down, because now there is a concern, if in case of a Credit Suisse, which is one of the very old banks and one of the very strong banks, if it can happen, what about these weaker banks then? That is the first impact. Second impact, what about the future issues? What about the future issues? Because the banks, in order to meet these capital requirements, will keep on issuing the bonds. So in the future issuances of such bonds, will the investor not demand higher coupon rate? Because now they know that there is a danger, our value might be simply written off by the bank. So the risk is much more than what we actually expected. So they might start demanding higher and higher coupon rate, and that would simply affect the capability of raising capital for these banks. And third one, what about the existing bonds? What about the existing bonds? Right? There is a kind of a panic that has been triggered amongst all the other existing bondholders in the market. Right? So these are some of the very important issues related to the concept of additional tier 1 bonds as well as the concept of COCOs, that is contingent convertibles, that is there in the context of Credit Suisse, as well as in the context of Yes Bank. Now before I wind up, what is the issue related to Yes Bank? The Yes Bank had issued lot of loans and incurred losses. NPAs shot up. At the same point of time, there were certain issues related to the management. Reserve Bank of India appointed administrator, and as a part of a reconstruction deal, the administrator announced that they will be writing off. Of course, after the deal was announced, the administrator announced that they will be simply writing off more than 8,000 crore worth of additional Tier 1 bonds. Against this decision, investors took to Bombay High Court. Bombay High Court ruled in the favor of the investors and stated that Yes Bank administrator is not empowered to do all of it. And there were also allegations of mis-selling these bonds to various investors by the bank sales force. Against the order of Bombay High Court, RBI as well as Yes Bank approached the Supreme Court of India. Now the case is pending in the Supreme Court of India. Now you'll have to wait and see in which side or in which way Supreme Court of India will be issuing the order in the coming days. So these are the various aspects I wanted to discuss. Based on this, a question here. Consider the following statements regarding additional Tier 1 bonds. These bonds are perpetual in nature. Statement 1 is correct. The banks issue them to meet Basel guidelines. Again, the statement 2 is also correct. So right option for the question will be option C, both 1 and 2. So if you like these initiatives, please hit the like button. Provide your valuable comments in the section below. And if you're yet to subscribe to BYJU'S Exam Prep IAS YouTube channel, kindly do it now. Thank you. Have a great day.